Hey small business owners, are you using all the data you're already collecting to your advantage? It's time to stop thinking of big data as something that only giant corporations use. If you're invoicing through QuickBooks, guess what? You're sitting on a gold mine of insights that you can transform your business with today. But here's the catch. Most businesses don't even realize they're gathering this data, let alone using it to its full potential. I'm Matt Krieger, founder of Krieger Analytics, and in the next few minutes, I'm going to show you how to unlock the power of your data with just a few simple steps. Ready to stop guessing and start growing? Let's dive into a revenue dashboard that will help you make smarter decisions to scale your business without the confusion. Stick with me and let's make your data work for you. I know when I talk to a lot of small businesses, one of the things they don't realize is how much data they're just naturally collecting. You know, when we hear about big data, we think about big companies and all the data they have and a lot of the work they can do to develop strategies behind that. And small businesses, I don't think, understand that they are collecting a large amount of data as well. And one example of this is in QuickBooks. If you're invoicing out of QuickBooks, you're collecting a tremendous amount of data that you can sit down with your team on a monthly basis and really kind of review a high-level dashboard to develop strategies. So I'm Matt Krieger from Krieger Analytics, your partner in financial prosperity. And today we're going to review just one example of what I'm kind of talking about here. This whole report, this dashboard report here, is being generated based off really just one report being downloaded out of QuickBooks. So here you can see, let me get over here. Here you can see the invoice list report that I downloaded out of QuickBooks. I downloaded over a 12-month period. It's really just a trailing 12 months. I'm blacking out some data here because this is actual client data and I want to be mindful of their privacy. But really just by updating this each month and inputting our accounts receivable balance, we can then generate this dashboard here. And that's it, right? Like there's no other maintenance on the sheet. There's no other things that you have to put in, no formulas you have to do. You don't have to rebuild this each month. This alone, just by inputting the new invoice list in here and updating your AR balance, and then I guess updating your date as well, builds this beautiful dashboard report. So let's walk through this real quick and let me show you like how this analysis could be really, really useful to a small business and to their leadership team, to the owner, about how they might want to change things or how they might want to function going forward. So at really a high level, the first thing we look at is we just look at revenue. Looks like we have some seasonality here. If we don't have seasonality and our revenue really was almost 3 times higher, 4 times higher in some of these months than we just had here in October, then we might want to investigate why. Why was our revenue 364 here? Why was it down by over $200,000 from September? Just something we want to talk through at a real high level. From there, we're looking at revenue per customer and average invoice value. If one of our things to do, and I always tell my clients, the easiest way to generate quick revenue is from your current customers. One of the most expensive things you will do is go out and find new customers in a lot of cases. And so, not to say that you shouldn't do that, but what we do want to do is look at this and say, well, how valuable is our current customer? And here you can see, well, on average, back in May, we were generating $51,000 per customer. Here it's $21,000 per customer. Now, I happen to know the line of business this client's in. That's actually somewhat normal. So this isn't really a red flag for them. But if you were in a different business, this would be a huge red flag. Why did your revenue per customer drop by 50% from May here into October? Same thing with average invoice value. A lot of businesses want to drive their invoice value up, whether that's just through doing price increases, whether that's by increasing the ticket size, increasing the number of items per ticket, whatever it may be. Typically, you want to see this average invoice value being driven up. Here, again, it's coming down. And again, I know why for this business. This makes sense for them. But if you were a retail business, this would be trouble. You don't want to see this be going down. So again, just by looking at those two things, you can see, okay, is my strategy of creating more revenue per customer working? Is my strategy of increasing invoice value working? Here we can see the number of invoices we did this month compared to last month. We did 25 this month compared to 25 last month. Is that good? I don't know. Did you expect to do more? Did you expect to do a little bit less because of seasonality? Were you hoping to do more because of some of your marketing efforts? Something you can see there. Total unique customers. So how many individual customers came in? We know we invoiced 25 times. We did that across 17 customers. So we had 17 unique customers. Were we, again, trying to grow that? If we were, we can see, well, we did 19 the month before. it didn't grow. So is that consistent with our expectations? Do we need to investigate that more? Here we can see that in October, we invoiced the average customer almost 1.5 times. Compare that to the trailing 6 months where it was 1.25 times. So we are invoicing the customer more in September. We're just invoicing them for less each time we do it. And there again is your average invoice value. And then here's your trailing 12-month sales. A lot of times people are just looking at sales, from January to this year. Really looking at that trailing 12 months gives you a little bit better of an idea on annually what your business is doing. Next, we're going to go down to accounts receivable. This just divides it up into buckets. And this is really, I think, from a capital standpoint, from a working capital standpoint, this is some of the most valuable information here that you can look at. Here, this tells me that my current customers are $300,000. Look at what our 31 to 60 day bucket is. Look at our 90 day plus. We're owed $250,000 from customers that are over 90 days due. Why is that important for working capital? Well, guess what? We didn't get to not pay our employees for 90 days. We didn't get to not pay our suppliers for 90 days. We're having to finance this. There's a real finance cost associated with this. Here, how many days does it take our customers to pay? And so this is essentially what we call our days in receivable or days outstanding. You'll hear to it AR days. You'll hear it referred to a couple different ways. But here you can see in October, it's taking on average 82 days for our customers to pay. And again, we're having to finance that. We're financing our customers for 82 days, probably at interest free. My guess is if we have a line of credit that we're paying our customers, paying our employees with, that's not interest free. And so there's a real financing cost into this. Here's where our current AR balance is. It's $963,000. Last month it was $1 million. So we did collect a little bit more than last month, but that also makes sense because our revenue came down. When our revenue comes down, we typically collect at a higher rate. 69% of our AR is overdue. So that's good to know. I mean, typically I don't want to see that really higher than 30%. Again, I know this customer's their line of business, so this is more than we'd like, but it's that 30% barrier that I just told you, that 30% benchmark doesn't necessarily need to apply to them. But for most of my clients, I'm looking for 20 to 30% being overdue. If it's more than that, then that tells me that we need to do something for collections. Percent of prior month's billings outstanding. So we billed $365,000. Well, guess what? As of the month end, 82% of that is still outstanding. We have not collected it. And so what's our collection efficiency index? And I think this is something that not a lot of people measure that's really, really valuable. But this is the percentage of receivables that we collect on time. Right now, it is 35%. And so if I was a business owner, I'd really want to do a lot to increase all of this. Why? Because it's going to put more cash on the balance sheet. We're not going to have to finance things. It makes our life easier when we have more cash in the bank. So again, I walked through this report. There's going to be a link in the description of this video about where you can access this report. It is for sale and you can just use it and populate your own data in here. But it is also just an example of how we can build some things based off the data that we're collecting. We didn't have to do anything special to collect this data. We're just invoicing customers. That's our normal business. So there's a lot more in QuickBooks that QuickBooks is in QuickBooks Zero, whatever your accounting system is. It's gathering a lot of data that you can use to really sit down and for 10 minutes a month, take a look through this and see, am I on track or do I need to alter some strategies and talk with my leadership team or change some things in how I'm doing my business. Not many business owners are doing this. You can put yourself way ahead just by doing this simple analysis each month. I'm Matt Krieger with Krieger Analytics. If you have any questions, feel free to reach out. Thank you.